start, give it like
Taking the time to join us today and participate in this conversation. My name is Elojo Joy, and I'm a graduate legal intern at Adun Legal. At the firm, we work closely with businesses, founders, and institutions navigating regulatory uncertainty, especially in fast evolving and highly regulated sectors. This webinar is part of our theme for the month, Navigating Emerging Regulations, where we are intentionally creating space to help businesses understand not just what the law says, but how regulatory change affects real decision making, growth, and risk. Today's session is designed to be practical, insightful, and forward looking. Whether you're a founder, in house counsel, compliance professional, or simply trying to stay ahead of regulatory shifts, you're actually in the right room. Let's take a moment to answer this question within ourselves. If a regulator walked into your business today, not because you did anything wrong, but because your product scaled faster than expected, would you know which rule applies to you or even which regulator is in charge? Most founders assume regulation is something you deal with after traction, funding, or growth. But increasingly, regulation shows up before all of that, sometimes even before founders realize they're operating in a regulated space. Today, the biggest risk for tech businesses isn't moving too slowly. No, it's moving fast without understanding the rules that quietly shape what you're allowed to build. This session is not about memorizing laws, sections, or compliance checklists. It's about understanding how regulation is changing and what that change means for founders, operators, and anyone building or advising tech businesses. Across the tech ecosystem, regulation is evolving in real time. Rules are no longer limited to traditional industries, and enforcement is no longer reserved for large corporations. Startups are now directly in the regulatory line of sight, not because they are failing, but because they are innovating. What makes this challenging is that regulation rarely announces itself clearly. It shows up through data obligations, platform responsibilities, payment structures, hiring models, and scaling decisions. Now, the goal of today's discussion is to actually break down these issues clearly and practically to help you recognize regulatory risk early, understand what truly requires attention now versus later, and learn how to stay compliant without slowing innovation. Now, whether you're a founder, part of a startup team, or just beginning to understand tech law, this session is designed to help you see regulation not as an obstacle, but as a framework you can navigate intelligently. Now, with that in mind, let's welcome our keynote speaker, Barrister Inoma Grace, who will unpack the core issues around navigating emerging regulations, what they are, how startups can keep abreast of all regulations simultaneously, and how to seamlessly comply with the regulations without breaking a sweat. Once again, thank you for being here. And over to our speaker, Barrister Inoma.
Hi, Joy. Thank you so very much for that wonderful introduction. I'm sure everyone now is abreast of what exactly we're doing and why we are here. So, thank you so very much for that. As she stated earlier, you guys, we are here to talk about navigating emerging regulations and basically everything that has to do with that. So, first of all, before we even begin, what are emerging regulations? So before we even begin, guys, what are emerging regulations? What exactly are they? And when people hear the phrase emerging regulations, they often assume that it refers only to either brand new laws that have just been passed. But in reality, it's quite broader than that. And it's a bit more subtle and it can be confusing for people. Emerging regulations are best understood as either new or evolving laws, rules, expectations, or enforcement approaches that affect how businesses operate, even when the underlying law is not entirely new. They reflect how regulators respond to new challenges, new risks, and new business models, or even new ways of operating. And one way that emerging regulations can be introduced is legislation, aka formal laws or registration or regulations created to address gaps that existing frameworks no longer cover adequately. However, legislation is only one part of the picture, and it's often the slowest because it has quite a number of processes to go through before the citizens have the laws in their hands. More commonly, emerging regulations take place or take shape through interpretation of existing laws and enforcement of existing laws, where regulators may begin to apply these laws in a new way to either fit modern technologies or modern ways of conducting business. A rule originally designed for traditional businesses may suddenly be enforced against a digital platform simply because the underlying activity now looks similar in effect, even if the technology is different or even if the mode of operation is different from the traditional way of doing business. Another key source of emerging regulations is guidelines, frameworks, circulars, and advisories. These tools allow regulators to clarify expectations without waiting for formal legislative change. And while they may not look binding on the surface of it, they often guide enforcement decisions and signal how compliance will be assessed going forward. Emerging regulations also develops through precedent and practice. So we have things like enforcement actions, public warnings, audits and compliance investigations, etc. They all shape industry behavior over time. And with startups, they often learn what regulators expect simply by observing how similar businesses are treated. And sometimes after penalties have already been awarded against those companies for non-compliance with the rules. What makes emerging regulation particularly challenging for founders is that it is often uncertain and incomplete. Rules may evolve while the products are already live. Different regulators may take different positions on the same activity. For instance, with fintech, we have a whole host of regulators, and one of the regulators might take a stance that is quite different from the other, and you can find that back and forth. So, while clear signals would not exist, you will see risk every single place that you turn. And this uncertainty leads many founders to either ignore the regulation entirely or overestimate its importance or its impact. And both responses are problematic because the goal is not to predict regulation perfectly, because that is very difficult and almost impossible to do. But the goal is to recognize when regulatory expectations are forming and adjust yourself, your business, and your business operations accordingly. Understanding these regulations is less about knowing every rule and is more about developing a regulatory awareness, the ability to identify when your product, your data use, your revenue model, or your user interaction is likely to attract regulatory attention. And once you understand this as a founder, you are better equipped to distinguish between real risk and background noise. You're able to prioritize your compliance efforts sensibly, and you're able to make informed decisions even in uncertain regulatory environments. In short, emerging regulations is not just about what the law says today, it is about where regulations are heading and the expectations of the regulators tomorrow. That way you're better able to plan your business. Now, how exactly is regulation evolving across technology? Because most people say that regulation is moving at a snail's pace compared to technology. Before regulation is out, technology has probably reached the global market. So, how exactly is regulation evolving alongside technology? For a very long time, for a very long time, technology operated in what many people described as a regulatory gray area. Innovation moved very quickly and regulation followed along very slowly. Founders could build, they could test, they could scale, and they could sometimes exit the market before regulators fully even understood the product and what exactly the product did. But now that dynamic has changed. Today, regulation is no longer playing catch up in the background. It is evolving alongside technology, sometimes imperfectly, sometimes aggressively, but all the same, it is evolving very, very deliberately. One major shift is that technology is no longer treated as neutral infrastructure. Regulators increasingly view these tech products as market actors with real social, economic, and consumer impact. Platforms They influence pricing, they influence data flows, employment structures, access to finance, and even the public discourse. And so, naturally, as a result of that, regulators are less interested in what you call your startup or your product or your innovation, and they are more interested in the function, what exactly that product does. Another important change is the move from general regulation to sector specific oversight. Instead of one broad law applying to all businesses, we now see tailored rules for areas like data protection, digital payments, online marketplaces, health technology, and several consumer facing platforms. This means two startups using similar technology can face very different regulatory expectations depending on how that technology is applied and what exactly it is used for. Regulation is also becoming more preventative rather than reactive. In the past, enforcement often followed harm. Let's say there was a data breach or there was a consumer loss or some kind of market abuse. But now, regulators are stepping in earlier. They are using these guidelines, these circulars, these registration requirements, even audits and compliance directives to shape behavior of founders and of product and of companies before damages occur. For startups, this means that regulation can affect your product design, your onboarding process, and several growth strategies from much earlier stages in your business. There is also a significantly noticeable shift in how enforcement happens. Regulators are not only targeting large and established companies, for all of you in the back that are saying, oh, wait, my startup is too small. Mm-mm. Regulators are looking at even the smaller and fast growing businesses because they scale quickly, especially with technology. They scale quickly and they reach users rapidly. So visibility is not the same as size. Visibility rather is what regulators are looking at. Functionality is what regulators are looking at rather than size. Finally, regulation is evolving in response to business models, not just your industries. Categories no longer work as neatly as before. A single tech business can look like a software company, a financial intermediary, a data processor, and a consumer facing platform all at the same time. So, regulators respond by overlapping mandates, which creates uncertainties for founders who are trying to determine where they fit. But the key takeaway in all of this is that evolution is simple but very, very important. Regulation is no longer something that arrives after innovation, right? It increasingly shapes innovation itself. And as a founder, understanding this first step in navigating emerging regulations is so very important because it helps you know exactly what you're supposed to do and when. And once you grasp how the regulation is changing, it becomes easier to identify risks, to prioritize compliance, and to make informed decisions without slowing the progress of your company or the products that you're shipping. Now, what are the key regulatory shifts affecting tech businesses today? Well, there's quite a few of them. And having established that regulation is evolving alongside technology, well, the next step is to understand where that evolution is most visible today. Certain regulatory shifts are reshaping how tech businesses operate, often in ways that founders don't immediately recognize. And one of those, or one of the most significant shifts, is the expansion of data related obligations. Data is no longer treated as the byproduct of technology, right? It is regulated as a valuable and sensitive asset. So, tech businesses that collect, that store, analyze, or monetize data are increasingly subject to specific responsibilities around consent, purpose limitations, security, and accountability. Importantly, these obligations apply regardless of company size. Another major shift is the growing regulation of digital platforms and user facing products. So, platforms are no longer seen as neutral intermediaries that merely connect users. Regulators are paying much closer attention to how platforms structure transactions, manage disputes, set terms, allocate responsibility between users. This means issues like unfair contract terms, opaque pricing, and inadequate user protections are now regulatory concerns, no longer just customer service problems. There is also an increasing focus on function over form. So regulators don't really care what you call your startup, as long as if that name differs from what the startup actually does, what your product actually does, that's more of what they're going to focus on, right? they are actually interested in the role that your product actually plays. What functions does it, what features and functions does it have? What role does it play in the market? If a platform facilitates payments, if it extends, say, credit like services, if it manages user funds or influences transactions, financial transactions in any way, it may fall within regulatory frameworks traditionally reserved for financial or commercial actors. And for founders, this creates risk where business models evolve faster than regulatory classifications. And you don't want to fall into the gap where you are not sure which functions and therefore which regulations apply to you, because that's a very confusing place for anybody. A further shift is the overlap of regulatory mandates. Many tech businesses now sit at the intersection of multiple regulatory regimes. For example, data protection, consumer protection, financial regulation, and employment rules. These overlaps increase complexity and uncertainty, especially where regulators approach the same activity from different perspectives. So the challenge for startups is not just compliance with one rule, really. It's managing competing expectations simultaneously. Regulation is also becoming more dynamic and guidance driven. Instead of relying solely on formal legislation, regulators increasingly use the guidelines, circulars, advisories, public enforcement action, etc., to signal expectations. Finally, there is a noticeable shift towards early intervention. Regulators are increasingly engaging with businesses before the harm occurs. Now, the next thing that we're going to address Now, the next thing that we're going to address is why build first, fix later is becoming a very, very risky strategy. A lot of startups, especially the ones that I know, are like, we can start building now and fix everything later, especially the legal. That's a very, 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 very wrong approach, especially now that regulation is moving almost at the same pace as technology. And so, for years or in previous years, build first, fix later was not just accepted in tech, it was encouraged because, speed to market mattered more than structure. Legal and regulatory issues were considered problems to solve after traction, funding, or maybe when you've achieved product market fit. But that approach worked only when regulation lagged far behind innovation. It is far less effective today for various reasons. And the first is that regulatory exposure now begins much earlier in a startup's life cycle. So activities that feel experimental to founders often look operational to regulators. For example, let's say your startup launches a beta product that collects user emails, location data, or usage behavior just to test engagement. From a regulatory perspective, however, that startup is already processing personal data and is expected to meet the data protection standards, even at a testing stage, whatever it is you might call it. The second reason why build first, fix later is a risky strategy is regulation compounds over time. Early decisions quietly lock in legal consequences. So consider a platform that classifies all its workers as independent contractors just to move quickly and avoid all the overheads. At a small scale, this is quite manageable. But as the platform grows, regulators and courts may examine whether those workers are functionally employees. Fixing that classification later can require renegotiating your contracts, restructuring your operations, and absorbing unexpected liabilities. And the cost of fixing these issues later is rarely limited to compliance alone. It often spills into the core operations of the business. Another example is if a startup designs its payment flow in a way that temporarily holds user funds, assuming it is merely a technical process. But as the platform scales, you'll find that this structure triggers financial regulatory obligations. And addressing this later might require re engineering your entire payment system, putting a stall on your operations, having to call back the product from the market. So, as you can see, this is way more than just updating your legal documents. And so, again, it's a very risky strategy. Another reason why build first, fix later is a risky strategy is there's also the problem of visibility, right? As you grow as a startup, the more scrutiny, the more eyes you have on you. A small online marketplace may operate informally for months without issue, but once it gains traction, regulators become aware of the platform. They become aware of the platform, and the practices that went unnoticed at an early stage suddenly attract enforcement attention. At that point, your startup is expected to justify the decisions that they made long before regulation was considered. So, but none of this means that, I mean, all of these reasons, none of it means that, you must perfect compliance before launching. No, the real danger lies in building without regulatory awareness. The shift you as a founder need to make is subtle but critical. You need to move from, yeah, we'll fix it later, to we know what we are deferring and why. We know what exactly requires priority treatment and why. And those ones that require priority treatment, we are actually giving them that attention and sorting them out. Others, we are deferring them and we know exactly why. Speed still matters, but speed without foresight just creates a fragile business, and it's a business that grows really fast but struggles to withstand any regulatory pressure once it arrives. Now, what are the common compliance blind spots that founders encounter when it comes to adhering to these regulatory obligations or with these emerging regulations? Most compliance failures in tech, they don't really come from a deliberate disregard for the law. They arise from blind spots, areas founders assume are handled, irrelevant, or low risk until they are not. One of the most common blind spots is the belief that having documents equals compliance. Many startups believe that once they have, let's say, a terms of service or a privacy policy or several user agreements, that they are legally covered. In reality, these documents only reflect compliance if the business actually operates in line with them. And when your internal documentation, when your internal practices diverge from your written policies, the documents themselves can become evidence of non compliance against you rather than the protection you thought that they were. Another blind spot is misunderstanding regulatory triggers. Founders often assume regulation applies only when a business reaches a certain size or revenue threshold. In practice, regulation is frequently triggered by activity and not scale, by function of the product and not size. Processing personal data, facilitating payments, offering consumer facing services, or structuring flexible work arrangements can all trigger regulatory obligations from the earliest stages, regardless of how small or big your company is. A closely related issue is the over reliance on labels. Calling a product a technology platform or a marketplace or a software solution does not determine how it is regulated. Again, regulators look at function, not branding. They look at exactly what it is that your product does, not what you call it. Startups are often caught off guard when their operational role attracts obligations that they believe applied only to traditional businesses. There is also the tendency, I guess, to treat guidelines, circulars, or advisories as optional because these instruments don't always look like formal legislation. So there's a tendency to toss them aside and they are often ignored. However, regulators frequently use these circulars, advisories to signal enforcement priorities and acceptable standards. And so when a dispute arises, these soft rules in the format or in the shape of circulars will shape how compliance is assessed in practice. Another blind spot appears during scaling. Now, many startups design compliance around their initial business model, but they fail to reassess it as they grow. New features, new markets, new user groups, or new revenue streams can quietly change a company's regulatory exposure. And without regular review, startups will continue to operate or continually operate under the assumption that they are compliant when in reality their business has scaled to the point where those regulatory obligations no longer apply to them. You also, as a founder, you can also underestimate internal operational risk. Compliance is often treated as an external facing issue, focused on regulators and users, while internal processes receive little or no attention, whether that's through poor record keeping, unclear responsibility for compliance, and informal decision making. All of these, and so many more really, can create vulnerabilities even where your intention as a founder is good. So there's also the blind spot of assuming that silence equals safety. The absence of regulatory contact, simply because the regulators haven't contacted you, you think that, oh yeah, you're safe. Mm-mm. In reality, enforcement is frequently delayed, it is selective, and is triggered by complaints, publicity, or growth. And by the time the regulatory attention does arrive, the issues must have existed for some time. And at that point, you have to answer to the regulators. Now, this is no longer something you can quietly or quickly take care of in-house. This is now something that has been blown up because now all of the regulators are involved. And so the key insight here is very, very simple. Compliance failures are rarely sudden. They accumulate quietly, right? They accumulate quietly. And founders who learn to identify these blind spots early are far better positioned to address risk deliberately, prioritize fixes, and avoid any unpleasant surprises as their businesses grow and evolve. Now, you're probably asking me, well, Norma, I've heard all of what you're saying, but how exactly does this regulation impact my bank balance? How does it impact fundraising? How does it impact my ability to scale my business? How does it impact the partnerships that I have? Well, sit tight and get your jotters out. Because for many founders, regulations like this feel abstract, right? Until it starts to affect your growth. But in reality, this regulatory posture increasingly determines who is willing to invest, partner, or even scale with a tech business. When it comes to fundraising, regulations often enter the conversation earlier than founders expect. Investors rarely see regulation as a secondary concern. They see it as a risk multiplier. A promising product with unresolved regulatory exposure can quickly become unattractive, not because the business lacks potential, not because the product is not good, but simply because the cost and uncertainty of fixing compliance later threatens their return on investment. And no smart investor would invest in a business that is not going to grow or that he's sure is not going to make at least some percentage of his money back. And during due diligence, investors typically look beyond your revenue and your traction to assess how exactly your business operates. They examine how your data is handled, whether the business model triggers licensing or registration requirements, and whether past growth has created unresolved legal risk. And where regulatory issues appear unclear or unmanaged, or there's something missing, then the deals are delayed, or your valuation is adjusted, or your funding is conditional on fixes that will consume both time and resources. Partnerships are also affected in the same way, but often more abruptly, I would say. Larger companies, financial institutions, and international partners operate under strict compliance obligations. And before entering partnerships, they assess whether or not a startup's operations could expose them to regulatory liability simply by association. And even a technically sound product can be rejected if the partner believes regulatory risk is too high or insufficiently understood. And in many cases, you as a startup or you as a founder would only discover these regulatory gaps when a partnership stalls. Requests for compliance, when they make requests for compliance documentation, when they ask for operational clarity, or when your regulatory assurances reveal weaknesses that were previously invisible internally. At that stage, you as a startup, you are forced to respond reactively typically under tight deadlines or under commercial pressure. And that is not a good place for any founder to be. Scaling introduces its own layer of regulatory complexity, where growth changes because naturally, as you grow, the nature of the risk your business is faced with or exposed to changes. So does the regulatory complexity you are faced with. And so you find that what was manageable at a small scale can become problematic when your user numbers increase or your transaction volume grows or your operations expand into new markets. These regulatory expectations tend to rise with your impact in the market rather than the size of your company. Geographic expansion is another common pressure point where let's say you're entering new markets now. It often brings with it new regulators, new standards, and sometimes conflicting requirements. And without a clear regulatory strategy, scaling can result in fragmented compliance, where the business meets expectation in one area but fails in another. So, with all of this, the central insight is this: regulation does not just respond to growth, it shapes the path of growth. And founders who understand how regulation affects fundraising, partnerships, and scaling is better positioned to plan strategically. And so, rather than treating compliance or regulate or emerging regulations as an obstacle, you can use regulatory clarity as a signal, or it can signal maturity, stability, and the long-term viability of your startup, making it all the more attractive to investors and other partners that you might possibly have, and even to users at large. Now, this is my favorite part personally, because founders are asking me, okay, well, now I understand how this affects me. I understand what emerging regulations are. I understand how they affect me. I understand how they can affect my scaling as a business, my fundraising, partnerships, yada, yada, yada. What can I do now? From where I'm at, what can I do right this minute? Well, first of all, regulatory clarity. In any business, you need to understand what you can do now in the minute and what can wait. And one of the most common reactions founders have when faced with regulation is overwhelm, because there are way too many, right? And you can't be expected to adhere to each and every one of them all the time, every time. It's very, very difficult to do. So you need to know what can you fix now and what can wait. What needs to be fixed now are issues that expose the business to immediate regulatory risk or irreversible consequences. These are areas where non compliance can trigger enforcement, penalties, loss of trust, or operational disruption at an early stage, which, for example, how the business collects, uses, or processes or protects user data, whether core activities trigger licensing, registration, or approval requirements, how your users are onboarded, how they are charged. Let's say your product has a financial charge to it. How are they charged? How are your users or customers treated in practice? And whether or not your business model creates consumer, financial, or employment related obligations. And if your business has any of these things or asks any of these questions, then that is a regulatory requirement that you need to comply with ASAP. Do not wait on it, because these elements sit at the foundation of the business. If they are flawed, growth amplifies all of the risks rather than reducing it. Remember what we said: regulations, not when you don't comply with regulations, it compounds negatively, and then you find that you end up spending way more time and resources fixing these issues, and these issues stream over or stream into it goes beyond the legal. Now it affects your operations, it affects your business model, it affects your revenue, it affects your product itself. So it compounds negatively. Non-compliance compounds negatively, so you don't really want to do that. Now, moving over to what can wait. These are compliance steps that are skill dependent rather than activity dependent. They include obligations that become more relevant as your operations expand, where or revenues increase or the business enters new markets. And while these issues should be anticipated, they do not always require immediate implementation at the earliest stages. Examples: advanced tax optimization, enterprise level data governance, formal risk management, advanced employment and benefit compliance, financial controls and auditing, cross border IP enforcement, and on they go. Ultimately, the danger lies at both extremes, where you ignore because ignoring foundational compliance creates a fragile business, but attempting to implement every possible compliance measure too early can drain your resources, it can slow innovation, and it can even distract founders from building a viable product. So the key here is informed prioritization. You should understand as a founder which parts of the business creates direct regulatory exposure, which obligations are triggered by your current activities as a business, and which risks increase with scale. So the question is not, are we fully compliant? The question is, are we compliant enough for where we are now and prepared for where we are going next? If you cannot, as you're watching this, answer that question with a yes or a no straight up, then you need to get yourself a lawyer. To be honest, there is no other advice I have for you. You need to get yourself a lawyer who will look through your business. It's your business model, your operations, your staff, your all of the your product, every single thing that you have as a business. Look at it and will answer this question in either yes or no, so that you can know what to fix now before you take the next step forward. Okay. Well, I think we've practically already answered this one. How do I stay compliant while still moving fast as a business? Well, one of the biggest fears that founders have about regulation is that it will slow everything down. It will slow your product build, it will slow basically everything that you have going on, it will slow it down. And compliance is often imagined as paperwork, approvals, long delays, the opposite of how startups are meant to operate. In practice, staying compliant does not require moving slowly. It requires moving deliberately. The first shift is understanding that compliance is not a separate stage of growth. It is a decision making filter. You don't, as a founder or as a startup, you don't need to pause your innovation to ask, are we compliant at every single step? No. Instead, you need to ask better questions while building. For instance, what data are we touching? By the time your engineers or your developers are able to answer, well, we need this data, you automatically know what data protection obligations to put in place so that when you're responding to the regulators or you're complying with any data protection laws, you know exactly what it is that you're responding with, right? Other questions are like, who are we affecting? What role are we playing in this transaction? These questions take minutes to answer, not months. And once you know the answer to them, you're able to comply. And you can see that it already dramatically reduces your risk. Another way to move fast as a founder without breaking rules is to build flexibility into your products and processes. Rigid systems are difficult to adjust when regulatory expectations change. And as we know it, regulatory expectations are changing every other day, right? So you need to have flexible systems, like a flexible onboarding flow, modular features, and adaptable policies that allow your startup to respond quickly when compliance requirements evolve without you having to rebuild from scratch. Founders can also move fast by focusing on high impact compliance areas first. Not every legal issue deserves the same level of attention. Concentrating on areas, when you concentrate on areas that directly affect users, data, money, or labor, it provides the greatest risk reduction for the least effort. And you find that this approach will prevent compliance from becoming a distraction rather than a safeguard. Also, you need to treat compliance as an iterative process, not a one time task. Startups iterate their products constantly. That means you should also apply that same energy towards compliance because compliance should evolve in the same way that your products evolve. So, when you have small periodic reviews of your operations, your features, your growth, your revenue, your systems, and all these plans, you find that they are far more efficient than major corrective actions after problems arise. Perhaps most importantly, founders should recognize that uncertainty does not mean paralysis. In emerging regulatory areas, perfect clarity rarely exists. Waiting for complete certainty can stall innovation unnecessarily. The smarter way to approach this is to identify risk, make reasonable assumptions, document all of your decisions, and remain open to adjustments as expectations become clearer. Next, we move on to the practical ways to legally future proof your business because regulators are changing every day and Your technology is moving and evolving. So, as a business, as a smart founder, you need to know how to future proof, to legally future proof your business. And to do this is you don't need perfect foresight. It's simply about building a business that remains legally resilient as regulations, markets, and technology evolve. These principles below that I will explain to you now will tell you how to do that in practice. The first is to develop an ongoing regulatory awareness. Regulatory awareness is not legal expertise. It is the ability to recognize when your business decisions intersect with regulatory expectations. Many founders assume regulation is static, something you check once and then move on from. But no, regulatory exposure shifts as your business changes. Launching a new feature, changing how you monetize users, onboarding a different customer segment, or expanding geographically can all change and alter the way regulators view your product. The second way is to monitor regulation without constant firefighting. Monitor regulation without constant firefighting. Many startups interact with regulation during moments of crisis, say a blocked deal, a regulatory inquiry, or an investor's concern. This reactive approach, it creates stress, it creates urgency, and it leads you to make poor decisions. Future proofing requires a much calmer rhythm. Instead of waiting for problems, founders benefit from periodic low effort reviews of how their business operates in in relation to known regulatory expectations. These reviews they need not be exhaustive or legalistic. They simply need to reassess whether assumptions made earlier still hold. The third way is to build strong but easily adaptable internal policies, not just external policies. Many startups focus heavily on external facing documents while neglecting internal practices. This creates a very dangerous gap because policies and contracts only protect a business if internal behavior matches or aligns with what is written. When regulators or investors or even partners examine your company, they're not just looking at the documents, they're looking at exactly how you live your life and you operate the company and how decisions in the company are made and implemented in practice. The fourth thing you need to do to future proof your business is to anticipate regulation before it arrives. Future proofing does not require guessing the exact form that a regulation will take, it requires recognizing directional trends. Because if regulators are showing an increasing concern about data usage, consumer protection, financial flows, or employment matters, it is wise to avoid building business models that rely on those regulatory blind spots or on regulatory blind spots in those areas. Because sooner or later, regulations will evolve to solve or to clear up those gray areas. And you don't want to be caught in the middle of it and now you're having to decide, oh, wait, we need to change our business model or things like that. The fifth step to future proofing your business is to design for flexibility. Rigid systems assume that rules will remain stable like that for a long time. And in tech, that assumption rarely holds. So future-proof startups design products, workflows, or processes that can be modified without major disruption to operations or even revenue. And this includes having modular features, adaptable onboarding flows, or policies that can evolve as your requirements change. This flexibility allows you to respond quickly when new obligations arise without freezing innovation. The sixth thing to do is to know when an uncertainty becomes risk. Now, not all regulatory uncertainty is dangerous. Some ambiguity is inevitable in emerging sectors. The challenge is knowing when uncertainty crosses into material risk, particularly when it affects users, money, data, or even your growth strategy. So, when uncertainty reaches that point, delaying clarification can create serious downstream consequences for you. And as a business, that is the last thing that you want. The last but not the least way of future proofing your business is to build with longevity in mind. Short term success can hide long term vulnerabilities. So, founders who build only for immediate growth only make or often make decisions that limit future operations. Future proof businesses, by contrast, are designed to evolve because they anticipate scaling, they anticipate challenges, they anticipate regulatory scrutiny, and some other or various other operational complexities. And so, because they anticipate these, they plan adequately for them. Future proofing your business is not about avoiding regulation, it is about building businesses that remain strong as regulation changes. And founders who adopt this mindset move with confidence, scale sustainably, and navigate uncertainty without panic. Ha, guys. Before we move on to the conclusion, is there any question? Okay, in the absence of any, I think we'll just take the conclusion and then I'll hand back over to Joy to continue. So now that we understand what emerging regulations are, the difference between what to fix now and what you can fix later, the appropriate mindset that you as a founder and mentor have, and the common blind spots that founders usually get into, especially when it comes to complying with these regulations and how not to get into them, and so many other things that we have covered in this 40 plus minute webinar for now. Technology is going to continually reshape how we work, how we trade, how we communicate, how we scale. And so, simply because of that, regulation will continually evolve alongside it. And so, this evolution is not a temporary phase. So, don't think it is and don't act that way. You need to future proof your business by all the many steps I've given you. And so, but it's not also a signal that your innovation is under any threat. It is a reflection of the growing influence that tech businesses have on markets, users, and societies. So for founders, it means that building sustainably requires regulatory awareness as a core business skill. The most resilient tech businesses are not those that ignore regulation, nor those that over engineer compliance, but they are those that understand how regulation shapes opportunity and risk, and they are able to plan accordingly. The recurring theme in all of this, in this entire webinar, is that you need clarity over complexity. Regulation becomes intimidating. Regulation becomes less intimidating when founders understand where it applies, why it matters, and how it connects to everyday business decisions. So when you approach this thoughtfully, compliance stops being a blocker and becomes a stabilizing force that supports growth, trust, and long-term value. And so you find that the goal is not perfection, really. It's preparedness. It's not certainty, it's informed judgment. Not fear, but oversight. Knowing exactly what you're supposed to fix now versus what can wait. And knowing exactly what functions your product solves in the market and planning therefrom. Asking smarter questions during the build of your product or during daily operations in your business so that you can integrate compliance easily into your business and what your business is doing. That way, it becomes a breeze. That way, it's not something that is tedious or cumbersome for you. Whether you're a small company just starting out, a mid-sized startup just about to enter their first fundraising round, or you have already scaled and you're probably about to IPO or something, it doesn't matter. Foresight beats fear every day. So yes, guys, that is it for emerging regulations. I do hope we learned something. I personally have learned a lot just going over this again. And so for now, I will hand over to Joy to wonderfully conclude this session for us. Thank you so much. Over to you, Joy.
Okay, thank you so much, everyone, once again for joining us for this particularly enlightening session. And a big thank you to our speaker, Barrister Norma. I can say for myself and for every single person that joined this session as well that we all learned a whole lot. And we're not just learning, we're also learning to take steps in the right direction. Thank you so much, Barrister Norma. Thank you so much to every single person that joined this webinar. And we look forward to seeing you in our upcoming webinars. Thank you so much.
Thank you so much, guys. Bye.